Welcome to Monthly Market Outlook by Kotak Mutual Fund. If we look at global economy, we are piloting through many challenges. On one side, inflation is worrying central bankers. Other side, geopolitical risks have impacted commodity prices. COVID might be behind us, but is certainly not out. Put all these things together, and one can be reasonably certain that we are not out of the woods. If we look at in the year-to-date 2022, commodity prices are still 20% higher, whereas all other asset classes are down, including gold, all the way to Bitcoin. Clearly, as liquidity went out and interest rates went up, we have seen tremendous correction in asset prices. The US inflation is now running at 4-decade high. They had last seen this inflation in the period of the 80s, and now they are seeing very, very high single-digit inflation. This has resulted into interest rates going up, but in the past, rate hikes were comparable to inflation hike, especially core CPI. This time, there is a large gap. Now, unless until inflation is going to come down, interest rates will have to rise far higher. It is not clear whether interest rates in US will continue to rise. There are mixed signals available. On one side, employment is near full. On other side, housing market is red hot, but the consumer inflation has collapsed quite significantly in the recent time. Is it the negative effect of Bitcoin? Is it the negative effect of correction in equity market as well as debt market? But whatever the case may be, there is a significant reduction in consumer confidence. And this is not about just estimate. It is even reflected in personal consumption expenditure on goods. Now, all the demand which was coming for white goods, consumer staple, have suddenly started disappearing in the first half of 2022 as liquidity became tighter and as interest rates went up. We have also seen correction in commodity prices. Aluminium is now below its May 21 price level. Zinc is down about 30%. Copper, which is generally harbinger of recession, it is down even compared to May 2021 level. Even food grains like wheat, soybean, sugar, palm oil, they have corrected. The commodity which we want most to correct, oil prices, has only corrected 10%. Let's hope and pray that oil prices also correct like other commodities. Generally, copper has been indicator of recession, and from its recent highs in March 22, it is down about 20%. Generally, copper demand slackening is indicator of global recession. Why are we not so sure about US interest rate trajectory? While employment and housing market indicates that Fed will have to raise interest rates at least as per the expectations of market or even higher, there are weakness emerging on consumer side. 50% of Americans are now living paycheck to paycheck. Consumer confidence is lowest since 1950. This is compared to inflation, which is highest since 1980. The stock market has the worst first 6 months since 1970. Mortgage demand is lowest since 2001. And more Americans are living on credit card debt. Now, what will happen to US economy? Will it go to stagflation? Will it go to slowflation? Stagflation means negative GDP growth and high inflation. Slowflation means high inflation but lower GDP growth, not negative GDP growth. Invariably, we have seen in US, stagflation ends up following slowflation in many cases. This year, will we see US economy sliding down into recession and inflation will remain high? Time will tell, but the omens are more towards stagflation, with second quarter US GDP expected to come marginally positive or marginally negative. The first quarter US GDP was down minus 1.4% in initial estimate. It was revised downwards to minus 1.6%. This has also resulted into correction in debt and equity market. Even in 2008 subprime crisis, the debt and equity market correction as a total correction was about $10 trillion. This time it is exceeding $15 trillion. The correction is sharp witnessed in non-profitable tech basket. Nasdaq has corrected, but within Nasdaq, the non-profitable tech baskets have fallen by more than 50%. As US interest rates have gone up, house prices have also gone up, and this has resulted into a scenario where housing has become less affordable and mortgage demand has been impacted adversely. However, the positive thing is that there are more job vacancies than unemployed people. Many people have moved out of labor force as they were making money on cryptos and stock market and real estate. Unless until this thing starts coming down, globally central bankers will have to be on vigil and keep on focusing on inflation rather than growth. Overall, from an equity point of view, generally when inflation bottoms out, thereafter equity markets have a bull run. Will this time be no different? If we pass peak inflation, can markets continue to rise sustainably? The one positive thing for US, European and English equity market is that corporate results by and large are still coming reasonably solid. Will US Fed follow European Central Bank? EU market has started pricing in a 75 basis point rate cut in 2023. US Fed interest rates are still expected to rise in 2023, but will it get influenced by what happens in ECB? The other interesting slide is related to Nasdaq. On an average, Nasdaq has fallen about 32% over last many corrections, and the time for correction is about 120 days. This time, the correction is already 31%, near median, and time is 153 days. If history is any indication, then probably we are looking at the process of Nasdaq bottoming out. We believe this whole movie is going to play out in two parts. The first part before interval is where inflation is rising. Central banks are raising interest rates to control inflation. They are taking away liquidity to control inflation. By raising rates and taking away liquidity, they believe demand will come down, and obviously there will be impact on growth. However, if the movie needs happy ending, then in the second half, they will have to lower interest rates, pump liquidity, inflate demand so that growth gets supported. But for that second half to begin, headline inflation should start coming down. Without the second half, happy ending will not happen. But for second half to begin, we need inflation to transit from higher levels to lower levels. Today, we don't have clarity as to what will be the duration of the first half, but we are certain that unless the movie needs happy ending, it will require second half. Coming to Indian economy, by and large, headlines have been fairly positive. Core sector grew by 18.1% in May, highest in 13 months. NPA levels in banking systems are lowest in 6 years. Railway freight went up 11% year on year. No doubt that previous year base was impacted by COVID Delta variant. NHAI laid 75-kilometer highway in 105 hours. Power consumption went up 17.2%, partly driven by heat wave. We were leader in digital payment system. Fuel sales went up because of the summer demand. And the negative side, PMI weakened to 53.9% from 54 plus on account of rising input cost. Yesterday evening, before we published this presentation, another negative news came out about India's trade deficit. For the month of June, it was $25 billion, much higher than previous month. The first quarter trade deficit is $70 billion. Obviously, this will have implication on rupee. So there is most of the good news, but one bad news about trade deficit and PMI. Within that, 1.4 trillion rupees seems to be becoming new normal. For last 4 months, GST collection has constantly remained above 1,40,000 crore. Exports driven by commodity price inflation has been improving, and we are now on the course to, we got last year $450 billion of exports. This year, we should be clocking roughly about $500 billion of exports. But mind you, against this exports, imports are also surging, and our trade deficit continues to remain a cause of concern. Capacity utilization, which had fallen below 50% thanks to COVID lockdown, is now reaching to pre-COVID level of about 75%. As capacity utilization starts increasing, companies have started looking to increase their investment. For FY23, we believe investments by central government, state government, and listed corporates put together will be about rupees 21 trillion. It's almost double of that what we saw in FY 2016. A large part of this capex is also driven by revival in housing market. As house prices have remained constant, affordability has improved. More housing inventory has been cleared, and that's why inventories have dropped. The top 10 listed developers have seen increase in their sales, and while there is no inventory in the system, the supply should ensure that pricing remains affordable. Housing at one point of time was about 12% of GDP. It came from 12% to about 8% of GDP. And now we think it's going back towards 12% of GDP over multi-year cycle. The God has been kind on monsoon side. While we did start first half of June with large deficit of about 40%, by end of June, it came down to 8%. And hopefully July and August, which are critical for agriculture, we will see a normal average monsoon. With monsoon supporting agriculture, there should be increase in farm income. It will also be supported by growth in agri prices all over the world. Put together, rural India should be supported by increase in farm income. Apart from farm income, the government will be spending money in rural economy through free food distribution, through Manrega and other allocation. Put all these things together, this year, rural India should be growing at a faster pace compared to last year. Corporate India's balance sheet continues to improve. For every one company getting downgraded, now 5 companies are getting upgraded. This ratio has jumped significantly from negative to positive post-COVID-19. However, like America, in India, the inflation impact is still felt in the economy. Consumers, especially at the bottom of the pyramid, are suffering from inflation. We have seen companies reducing grammage in their packets, and despite reduction in grammage, they are not witnessing positive sales growth. The large packs across urban India are witnessing negative growth, and smaller packages are seeing some positive growth. Clearly, if people were buying or taking 5 biscuits in a packet earlier, now probably they are taking 4 biscuits in a package. We get seriously impacted by oil. This year, our oil import bill is up about 90%. Clearly, what happens to oil prices will have material impact on Indian economy. Negative part on oil is that US had released oil from the strategic petroleum reserve, and because of that drawdown of 1 million barrel a day, US inventory levels have fallen, and this could have negative impact on crude prices globally. While metal prices have corrected, oil prices have barely come down. What we need is oil prices to drop like metal prices. Let's hope and pray that oil prices come down. Like US Fed rate, there is no clarity on oil prices. In fact, two sell-side analysts has given, next slide please, Avinash. 2 sell-side firms have given exactly opposite view on oil. JP Morgan sees $380 of oil on worst case Russian scenario, and Citi is talking about $65 oil on recession fear. Let's hope and pray that Citibank's forecast comes true. That will support Indian economy as well as Indian market. Our inflation trajectory remains firmly tied to oil. If oil remains at about $105 a barrel, Inflation will come down to about 4.6% by March 2023. It will be after a period of almost 9 months where Indian inflation remains above RBI's target level. But in case oil goes to 120, then whole of FY23 inflation will remain above RBI's target range. Inflation continues to be driven by commodity prices. Hopefully, these numbers will have some sobering effect as bearing crude, other commodity prices have started coming down. Globally, food inflation continues to remain strong, but thanks to the monsoon in India, food inflation remains reasonably under check. Put all these things together, if crude prices remain high, we are looking at about 6.8% GDP growth. At the current, it should be about 7.3%. And if we are lucky on crude, we will see probably between 7.7 to 8% GDP growth. Converting this into equity markets, the small and mid caps have outperformed large cap over a 3-year period, but year to date, both of them have underperformed large cap. Sectorally, energy has done well year to date, whereas pharma and private bank and metal have corrected. On a 3-year basis, energy, real estate, auto has done well, whereas media and private bank has underperformed. The FPI selling has been relentless. They've sold $32 billion since October 2021. That's higher than what we have seen during global financial crisis of 2008. If India's story is bullish, why are FPIs selling so much? Well, there could be multiple reasons. One, India continues to trade at much higher valuation compared to its peers. We are now double the valuation of our peers like China, Brazil, South Africa, Indonesia, Turkey, Mexico. Maybe people are booking profit because we are expensive vis-a-vis peers. The second reason could also be because they have made so much money on India. Since 2014, emerging market has delivered 2.8% return. India has delivered 7.6% return. Since 2003, emerging markets have delivered 10% return. We have delivered 30% more return. We have delivered better return than China, Brazil, South Africa over the decades in US dollar terms. And that's why probably people are booking profit. Next slide, please. The selling by FPI has been heavily focused in banking and IT sector. No wonder you saw that banks have underperformed the market over 3-year period. The positive side against FPI selling is thanks to all of you. We continue to get very good SIP flows of more than 12,000 crore a month. Many people have asked me this question, Nilesh bhai, FPIs are selling and we are buying. Are we giving exit to FPIs? Well, only in the hindsight we'll know the answer. But I know for sure if FPIs were not selling Indian equity, then with this kind of inflow, we would have been buying Indian equity at 20,000 Nifty, not at 16,000 Nifty. It is thanks to FPI selling that we are able to get Indian equity at cheaper valuations at reasonable prices. Let's hope and pray that oil prices come down and then the same FPIs come to buy from us these equities. The other way to look at your impact on market is this. In the past, whenever FPIs used to sell, our markets used to correct significantly. In 2008, they sold about 52,000 crore. Our markets went down 60%. In 2020, they sold 48,000 crore. Our markets went down 38%. This year, they have sold close to 2,55,000 crore. And our market is barely down about 14% at current level and 21% from top to bottom. This is possible only because of all of you who have handhold retail investors and converted them into long-term investors. When will FPI selling stop? Well, there is no easy answer. But if we look at their holding, in December 22, they were 21.5% of NSE 200. In March 22, they were 19.5%. In the month of June alone, they have sold 58,000 crore. My feeling is that right now, this number, June 22, will be reasonably well below 19%. That is comparable to the lowest level of FPI holding in last 5 years at 18.6% in December 17. Maybe at the risk of going wrong, I will say that FPI selling is coming nearer to the end. This is despite the fact that in the month of June, selling has actually increased, and after March 22, it is one of the highest selling. This selling can also be influenced if HDFC Bank enters into MSCI indices in place of HDFC. If that happens, India's weight in MSCI goes up, and many of the passive index fund will start buying into India, converting FPI outflows to inflows. During global financial crisis, FPIs had sold about 1% of India's market cap and about 5% of their overall holding. Currently, they have sold about 0.8% of market cap and about 4.2% of holding. Clearly, it shows that we are reaching to the level of global financial crisis, and undoubtedly, India today is a better bet than many other emerging market peers. Next slide, please. Crude has hit $100 in 2008, 2011, 13, and 2022. Whenever commodity prices goes up, crude goes up, people prefer commodity producer like Brazil and Russia. In 2008, India's GDP was 33% of Brazil and Russia put together. In 2013, we were little better at 39% of their GDP. 2022, we have become 100% of Brazil and Russia GDP. This is despite the fact that Russian ruble has appreciated in this sanction time. Undoubtedly, if people take this trajectory going forward, they will be looking to invest in India rather than exit. The other way to look at this is a very interesting chart prepared by my colleague Harish Krishnan. He has mapped FII inflows in emerging market in post-2008 global financial crisis. This is all India allocation, and the brown line represents emerging market allocation other than India. In the COVID phase, FPI inflows have moved more towards emerging market other than India. This is especially true after they started selling from October 2021. They have pumped in close to $200 billion in emerging market, excluding India. But they have lost tons of money in China. They have lost tons of money in Russia. Now, will they make a U-turn and cut their losses? And will they start investing in India? If that happens, then we will see this blue portion increasing and the red portion probably coming down. As you can see, this is one of the longest phase where FPIs have invested in emerging markets other than India. One question which I have been asked many a times, Nilesh bhai, agar FPI selling chalti rahi, to what will happen to domestic investors? Well, we have enough firepower at today's level to absorb FPI selling. The cash levels in Indian equity mutual fund is about 5%. That's roughly 70,000 crore. While we do have to keep some cash to meet redemptions, as market becomes more cheaper, this cash can be deployed. The balance advantage fund is roughly about 1,75,000 crore by way of AUM. Assume that only 50% is invested into equity and they can raise it by 30%. That's another 50,000 crore. NPS cash availability could be about 15,000 crore. EPFO allocation in FY22 could be another 40,000 crore. And this is without taking into account the proposed limit increase in equity investments. And most importantly, thanks to all of you, we could be looking at SIP flows coming into the market of about 12,500 crore. So 1,50,000 crore could come by just way of SIP. 70,000 crore investment from existing cash balance. 50,000 crore by way of increase in equity allocation in balance advantage fund. 40,000 crore from EPFO. 1,50,000 crore from SIP flows and 15,000 crore from NPS. This effectively means that there could be potential inflow of 3,25,000 crore if market becomes cheaper, if market becomes corrective. Of that, we have to take into account some redemptions which may happen. Even if I assume 1 lakh crore redemption from existing investment, that still leaves about 2,25,000 crore worth of domestic investments which can absorb FPI selling. Undoubtedly, I believe if oil prices come down, we will see FPIs capitulating to buy Indian equities from local investors. Valuation-wise, today we are still in neutral territory, but hopefully we will be approaching overweight territory if market corrects another 10% from here. The profit to GDP ratio has moved from 2.2% in COVID impacted 2020 to 4.3% in 2022. And if oil prices support in 2023, that number could be almost touching about 5% level. Within that, the large cap companies' results are far better. In mid cap and small cap, one will have to be little bit circumspect. After 200 companies, almost 107 companies have witnessed earnings downgrade in mid cap space, whereas 49 companies have neutral, no change, and 42 companies have seen earnings upgrade. Another interesting chart presented by my colleague Harish Krishnan has shown how market cap of India has moved along with long-term profit pool. The brown line represents the long-term profit pool. The blue line represents the market cap. There were periods where market cap growth was below profit pool growth. There were periods where market cap growth was ahead of profit pool growth. But now with this correction, they are merging. And hence we believe 10% from current level, 10% below current level, we will be looking at a level where markets will start becoming more attractive to invest. The global market cap to GDP ratio has sharply corrected to 103%. Indian market cap to GDP ratio has corrected to 93%. And while it is at a premium to 79% market cap to GDP ratio average, compared to global market cap to GDP ratio, we are still in a reasonable territory. Next slide, please. Without taking into account the earning revision, which is likely to happen post June 2022 quarter, as of today, Nifty P and PB ratio seems to be around historical average. The top 100 companies valuation is reaching their historical average of about 20 times forward earning. As I mentioned, this earning for FY23 for Nifty 50 company is likely to be revised downwards, partly because of windfall tax effect on Reliance Industries and ONGC, and partly because of June 22 quarterly results. If this number is roughly about 825 rupees, 825 into 18.5, which is our historical average, roughly at 15,262 Nifty, markets will start becoming attractive or below historical average from a valuation point of view. At this point of time, our view continues to remain marginally overweight large cap and marginally underweight small and mid cap. And we believe every correction will become an opportunity to increase allocation in equity, albeit on a gradual basis, not at one go. Why should someone invest in this correction? Because after every mandi, there is a teji, and if you invest during bad times, you also make better return on the way up to the market. Coming quickly to equity investment opportunities, we have funds which can best be described as the old Panchtantra story of hare and tortoise. For example, our Kotak Equity Savings Fund invests between 10 to 50% in equity. Over last 8 years, equity allocation on an average is 29%. But with that 29%, we have given upside of about 39% and downside participation of about 14%. This fund goes up 2.8 times more higher compared to one-time fall. In multi-asset allocator fund of fund, over 18 years, historical equity allocation is about 46%, upside of 65%, and downside participation of 30%, 2 times more upside than downside. In Balance Advantage Fund, which has 4 years history, average allocation of about 43%, upside of 57%, downside of 36%, 1.6 times upside downside ratio. These are the funds, while going up, they run faster like hare, while coming down, they fall slowly like tortoise. In the large cap space, we continue to have one fund, Kotak Blue Chip, which continues to deliver alpha over last many years. And because of this consistent alpha generation, we have received 18% of inflows in large cap category. Undoubtedly, Kotak Blue Chip has now emerged as the largest mobilizing large cap fund in terms of inflows. Our fund, bearing few exceptions like Flexi Cap Fund, continues to generate alpha over 3, 5, 7 and since inception period. Our hybrid fund, like Balance Advantage, Equity Hybrid, Asset Allocator, also continue to generate positive alpha over a longer period of time. The SIP in the same equity funds also have generated alpha across most of the time periods, bearing flexi-cap fund. Even in hybrid funds, alpha generation continues to remain fairly strong, and the SIP returns are almost double-digit across various time periods. We had launched multi-cap fund last year. The NAV of that is down about 10%. This fall is because of the market correction. And I'm very happy to say that despite this 10% correction, the fund has generated positive alpha in last about a year or so. At present, the fund continues to remain overweight large cap and equal weight to small and mid cap, which is mandatory as per the offer document. One fund which has given a lot of heartburn to investor is our Global Innovation Fund of Fund. We had launched that fund last year, and today it's down 35% from the launch. It's one of the worst performing fund in our forte, but this is mainly driven by the fact that post this fund's launch, series of events have happened which were not anticipated. The Chinese government went after the technology stock. It corrected significantly. US Fed started increasing interest rates, and there was a meltdown in global technology stocks. In Nasdaq 100, half the stocks have fallen 50%, where Global Innovation Fund had a large exposure. Unfortunately, because of the RBI limit, we are not even able to accept investors' money in this fund beyond a small amount. This fund has failed to meet investors' expectation in its short existence. The fund manager, Wellington Asset Management, continues to restructure portfolio, and they are positioning this fund for the upside as and when it comes. We will request your patience on this fund. I'm sure this fund is in the process of bottoming out and will start its upward journey if there is some settlement around inflation and US interest rate direction. There was another fund called Kotak International Reit Fund of Fund. This was one of the Reit fund launched by us. Over there, if we look at underlying fund, which is SMM Asia Reit Subtrust, they have delivered double-digit returns since its inception in 11 years. However, on a last 1 year basis, driven by property price fall and currency depreciation, returns have been negative. However, if we look at over a period of time, this fund has a fairly positive performance. I hope and pray that this fund also takes off like its past, where property prices and rental income have bounced back. Should we invest in gold? Well, for last couple of years, last actually 2 years, we have been fairly bullish on gold. In the month of March 20, when we had given gold overweight call courtesy COVID-19, it worked pretty well in 2020 to give 18% return. 2021 was a letdown. 2022 began on a good note. Now, gold call is facing two opposite forces, one bullish, one bearish. The positive side is that a lot of central bankers around the world will be looking to buy gold as part of their foreign exchange reserve diversification. When Russia had designed on Ukraine, they kept $150 billion out of their $600 billion reserves in gold. If China has designed on Hong Kong, if China has designed on Taiwan, quite likely that they'll keep some part of their $3 trillion reserve in gold. This is positive for gold prices. However, the negative part for the gold prices is that government has increased import duty to 12.5%. With GST and other taxes, effective duty becomes 16%. What you get in Dubai at $100, you are going to pay $116 in India. God forbid, if tomorrow import duty comes down, this can come down dramatically just overnight. One can lose 16% of their gold portfolio in case import duty becomes zero. This is comparable to almost 1.5 to 2 years return. So clearly, when you're investing in gold, you'll have to be aware of this risk factor. It has huge risk on both the sides. On the cryptos, the bubble continued to burst. Crypto market capitalization is down 70% from 3 trillion to about below 1 trillion. And lots of fault lines on crypto is now getting exposed. Platforms are shutting down. Hedge fund founders have run away with investors' money. Clearly, crypto bubble is unveiling. Coming to the fixed income side, we are in a world where growth is coming down across the globe and inflation is increasing. This has resulted into sharper increase in US Fed rate. In the month of March 22, Fed rate was supposed to peak at 2.8%. Today, as we speak, it is supposed to peak at 3.8% in 2023. And thereafter, there will be 40 basis point correction in 2024. Clearly, increase in inflation has pushed up Fed fund rates projection. As Fed funds projection started going up, it was reflected all over the world. UK 10-year yields have increased. Germany from negative has become positive. Brazil has moved from mid-single digit, high single digit to double digit. The only exception is China, where actually interest rates have come down. Globally, in 2020, thanks to COVID, there were 162 central bank cuts and only 6 hikes. In 2024, ratio is reversed, 124 hikes and only 4 cuts, primarily in China. RBI's inflation projection have continued to move higher. In first quarter FY23, that's June 22 quarter, they are looking at inflation at 7.5. September 22, they are looking at 7.4. December, they are looking at 6.2. And only in March 23 quarter, they are looking inflation coming below their upper end of target range of 6%. 9 months running, they are looking at inflation to remain above 6%, which is the upper end of their target. In fact, their full year FY23 projection at 6.7% is also above their upper end of target. This higher inflation has pushed RBI to raise interest rates. They have increased repo rate by 90 basis points. More importantly, they have cut down liquidity significantly through various mechanisms, including VRRs. The hawkish commentary by RBI has ensured that 10-year government securities minus overnight rates today trade at 276 basis points. Historical average is 164 basis points. That means market is factoring in another 112 basis points of repo rate hike. Repo rate was 4%. With 90 basis point rate hike, it has become 4.9%. And with another 1.12% rate hike, the terminal repo should be somewhere around 6%. This is what should happen over a period of time. A lot of it will be front-ended rather than back-ended, but at the current level of 10-year yield, 6% repo rate is well discounted. If you look at yield curve, it is extremely steep between 3 months to 3 years, and then it is becoming flat from 7 years to 40 years. The gap between 7-year GSEC and a 40-year GSEC is just 30 basis point, but the gap between 3-year GSEC and 3-month GSEC, 7.2 to 5.1, is almost 210 basis point. It is 7 times more than what is there between 7-year and 40-year. Clearly, yield curve is very flat over here and very steep over here. The mid space between 3 years to 7 years looks good from an investment point of view. The good part this time is that Indian real rate minus US real rate is actually in a positive territory. For last 8 months, Indian inflation is below American inflation, and Indian interest rates are higher than American inflation. So we are in a much, much attractive position for global investors from a debt market point of view. If you look at change in the yield of Indian credits, SBI or HDFC credit spread has widened far lower compared to global bank dollar bond index spread widening. It shows that global investors are more bullish on Indian credit. Within the fixed income space, you should be looking to invest where portfolio duration meets with your time horizon. At the short part of the curve, invest in money market savings and low duration fund. For medium-term horizon, look at corporate bond fund, floating rate fund, short-term bond fund, or PSU debt fund. And over longer term, look at dynamic bond fund or bond fund. I would like to highlight how our dynamic bond fund over last 4 or 5 years have delivered decent outperformance over benchmark index, even though index is difficult to replicate. For those investors who are worried about low interest rates, low returns on fixed income category, they should be looking at hybrid schemes. Kotak debt hybrid scheme, Kotak equity saving schemes, Kotak equity hybrid schemes all have different allocation to equity. In debt hybrid, maximum equity is 25%. Equity savings, it is 50%. And equity hybrid, it is 80%. And all these funds, while in a 1-year basis have delivered mid-single digit return, over 3 to 7 year basis have delivered almost high single digit to double digit return. So clearly this funds with higher volatility has potential to deliver better return to conservative investors.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.